Let's check in with Mark Todd, Director of Institutional Relationships at FIG Securities in Sydney. And a warm welcome back after a week of having not spoken, Mark. Let's talk about our consumer prices. Things move so thick and fast. We got the producer price number. It was softer than expected. People said, don't believe there'll be a follow-through. Carve it up, see it for what it is, and then CPI softer.
Yeah, that's right. I mean, I think the CPI, it caught the market by surprise. It was softer than they expected. We were leading into the same expectations on the retail numbers. They were as weak as we thought. The food prices were up a little bit, but all in all, I think the Reserve would be pretty happy with that CPI number.
Well, what does it do, though? Is this sort of calm before the storm? People were saying, and yet, don't rest on your laurels. We've got, projects that are going to come online. Companies have expressed those intentions. Wages are only going to go one way, and that's up. And what about the food question?
Yeah, I think it's around the, it's a reaction to the RBA. They like to keep the inflation within the 3% range, and they won't want to see it higher, but I think they need to be very cautious, and they've signalled they're going to be fairly cautious. And what they'll look to do is see how permanent these changes are, so it'll be all around that one-year cycle. We've got the Treasurer came out last night and spoke about the fact that there isn't enough people to meet the job requirements that they've got in rebuilding Queensland, so they'll be cautious about that. They'll look for, let's say, look for more bang for their bucks as best they can. So the RBA will be looking for inflationary impacts, and it can understand the food and the prices. They could understand some of the wages, so it'll have to be moderated. But we're still seeing retail numbers looking very weak. So it'll be around about the balance and how they segment it.
Well, if anything, are you saying a 6-month pass through and an assessment, remembering that rates rose in November, correct, is when we can next expect perhaps the next round of tightening, i.e. May?
Well, the market had been expecting in the second half of the year that it was going to be a tightening in the May-August period, and I think that's now going to be off the agenda. I think that the RBA will sit and wait, and I think they'll see the CPI, the first one coming through. They might wait for a few more, but they'll need to see the impact on GDP of this total devastation that we're seeing in Queensland.
How's it being ahead of the curve, though, to wait and see? So you're saying if the number isn't really as significant as even 0.5% impact to GDP, and they've waited to see, don't they run the risk of it running out of control?
I think they're going to be looking at the government policies. They're going to be looking at the policies that are coming into the system, and they're going to look at the capacity of those policies. So if the government is fighting in a hung parliament environment, and it'll say how accurate is our estimation that they'll be able to get these policies through and these projects up. So I think they've got time to manoeuvre. They've had a rate rise in November. It's still coming through the system, so there's no reason to push it too early. You've only got a certain amount of bang in your buck at the moment. We're seeing the Chinese government lift fairly heavily. We've seen the US saying they're going to try and be very strong on their fiscal policy. So, it is a lot of data that's coming through at the moment, and there's a lot of thoughts being put into this. A lot of people are making amazing claims about what's going to happen. I think the RBA would be wise to sit back and counsel a little bit, because when it goes, it'll be very dramatic. And I think everyone is getting fairly conservative in their approach, so I don't think they're going to see a need to raise. You see a levy come through, that's a raise in itself. So I don't think you need to raise straight away until you see the effect of GDP, the loss of receipts, the impact of a $1 to $5 change in people's levy price. I think they'll like to wait and see the hard data rather than the guesswork.
All right. Meanwhile, let's just also ponder the banks, the pass-through as well, because as every month goes by, the RBA does nothing. You get a sense that that old rationale is even harder to contain. In other words, using a rise in the OCR to push through an above and beyond rate rise. What will the banks be saying about margins?
Well, I think the banks are in a tricky position for a couple of reasons. One is they've got old debt that's maturing that was, let's say it's 35 over the BBSW, and we're now getting new debt that's more like 100 over the BBSW. So they're getting more expensive funding coming into their book, and so their overall book is getting more expensive. So they have to try and articulate that message to the market. They've got problems with the government, because the government said we don't want price signalling. They've got problems with their shareholders who are saying, okay, what are the costs of the funds? And they need to make the case that their cost of funds are now greater than 50% of those costs of funds are wholesale banking and term deposits. So that link, or that need to decouple from the RBA, is very strong within the banks, and they've got to start making that case. Now, it's not easy for the banks, because they haven't been good, and they've admitted this themselves. making the case for why they need to lift rates. So they're going to have to learn that lesson and try and work out within this political environment how to talk about their cost of funds.
Is the Bankers Association effectively a sort of a defunct mechanism? I thought that was meant to be the body that put these views collectively of the sector. If they're acknowledging a fault, why are they persisting with the ABA?
Oh, I think it's, let's say there's a lot of ego in the room. I mean, I think they're going to follow a policy that's stood for a long time. I mean, the Bankers Association has been very effective. It would be fair to say that this is a very different environment that people are now working in. So it's hard to say let's cut an ABA association which has worked for years, and it's been a more benign environment. The government's had, the support of the four majors. So why would you want to change that now? I think the four majors, the bosses of the four majors have been at the Senate committee, and they've said we have poorly addressed the concerns of the consumer, and we need to articulate that. And I think they're seeing that poor representation reflected in some of their numbers. We've seen growth in mortgage books for the fifth pillar. The mutuals, the building societies, the credit unions are seeing a growth in their business from the banks. They're taking market share of banks at the moment.
Mark Todd, we must leave it there from Fisher Securities. Great to talk once again. We'll see you next week.
Great. Take